Eric, almost in not contradiction to that, but in contrast to that, I know that you've noted that with personal rates of tax going up and the corporate tax regime softening very slightly, there's a question for how much wealth is kept within a business by an entrepreneur and a business owner.
A lot of my clients are reluctant, even where they've run so-called lifestyle businesses, where the business exists fundamentally just to provide personal wealth for the owners. A lot of those clients are becoming increasingly reluctant to take large amounts of money out of the business because they, A, don't like a 50% top rate of tax, and of course there may be national insurance on top where you're taking salary or bonuses. A, they don't like it, and B, they don't think it will last. There's a general feeling that this might be around for the next 4 to 5 years. We get out of recession, we do something about the deficit, and the top rate will come down. And I think on balance, I think I'd probably agree with that. I think that is probably going to happen. 50% is probably politically unacceptable in the long run, I think, in the UK. And if that's going to happen, then there is an incentive not to take huge salaries or bonuses out of the company immediately. I mean, you have to ask yourself what you're going to do with that money, unless you're actually going to spend it because you've got a huge mortgage or very expensive shopping bill or something, then you're probably going to invest it. And you go and see Derek and ask him to invest it for you. But there's no reason why you shouldn't do that within your company. And if you retain the profit within the company, then the worst rate of tax you're going to pay is 28%, and it's going to decline over the next few years to 24%. And that's a big difference between with the 50% rate, the top rate that you would pay on very substantial amounts of money, anything over 150,000. If your income's over 150,000, you're going to pay over 50% tax.
Is that not going to lead to a lot of complexity for perhaps, as you described, in lifestyle business owners to find themselves with trying to maximise the wealth within the business by investing in other businesses? It starts to create structures and issues for them that they may find.
Well, they may not invest in other businesses. I mean, they could, for instance, form a subsidiary company to their existing company and use that as an investment vehicle and go and give Derek £500,000 or whatever the amount of monies that they've accumulated, and ask him to invest that in much the same way as he would if it were a personal discretionary portfolio.
Do they have to be careful if they do that they don't end up making the core business not benefit from certain reliefs and things? Does that happen sometimes? Or is that
yes, I mean, and that's the point about going into a subsidiary company, and it's also relative. I mean, you can lose business profitably if you've got too much in the way of investment assets, for instance. But I think if you do it carefully, you can chart your way through that minefield, and I think then there's a secondary advantage in that if you build wealth up inside the corporate vehicle, and eventually you sell it, then following the budget on the first £5 million of gain, you're only going to pay 10% tax, which is an even bigger differential when compared with the 50% rate.
So there's a double benefit in that you're building the overall value.
Yeah, and if it's a family business and you've got
yeah.
members of the family involved, you might have a husband, a wife, and 3 children, say, involved in the business. That's 5 lots of entrepreneurs relief at £5 million a throw. That's £25 million of gain at 10%.
Yeah. So the increase to £5 million per individual in the budget, that seemed quite a giveaway.
Yeah,
from what I was saying,
and that's turned something that was seen as a reasonable incentive, but nothing much more, into something very significant. I mean, the original entrepreneurs relief at £1 million, when the tax rate was, top rate of capital gains tax was 18%, and the entrepreneurs rate was 10%. The differential is 8% on £1 million, which is £80,000, which if you're selling your company for 10 million or something, £80,000 is kind of helpful, but isn't seen as massively significant. Whereas now, the differential is not 8%, it's 18% between 10 and 28, and the amount is multiplied 5-fold, and it's now a very significant relief.
I mean, even so, it sounds to me that general strategy, I know the figures have changed as you've just explained, but that general strategy makes sense in good times as well as bad, doesn't it? Or
it does, but I think it's something of perhaps a British, I was going to say a British disease, that's perhaps an exaggeration, but we do seem in this country to have a desire for a larger proportion of so-called lifestyle companies than you would see in, say, Germany.
So general question, can we see the nature of enterprises that entrepreneurs launch and manage changing because of this changed CGT regime and others. I wonder if there's
I
any
suspect-
evidence.
I suspect a lot of care needs to be given to the ownership if you can now use the allowance several times depending on who owns the business. So I guess people are going to come to you for advice on how do I change the ownership of the business to benefit from these reliefs. That sounds like it should happen.
I think that's certainly the case. In terms of the nature of the businesses, I'm not really sure that that's going to change significantly because of the increase in the rate, particularly. I don't know whether you think that that's the case or not, Eric.
I mean, I've had clients who've prepared for this, who saw when we knew the 50% rate was coming, it was advanced, it was announced in advance, and we have seen clients pay quite substantial dividends, millions of pounds of dividends in some cases, to the family owners of the business, but not to take the cash out of the business, simply lend it back into the business, and they will draw on that over the next few years, and they will only have paid 25% on those dividends when they took them in the previous tax year. So some people have been cute and have prepared, and they will not take large bonuses, they will not take large dividends, they won't pay the 50% rate of tax because they've got a pot of lower tax money to draw on over the next few years.